Good morning. Welcome to our Be Informed session where we talk to industry leaders very informally. And today we have not one, not two, but three senior industry people from Ambit joining us. And thank you, Sushant, Manish, and Aishwarya, for taking your time out on a Friday to talk to us. So,
Ambit? Yeah.
quickly to introduce Ambit and Sushant. Sushant is the CEO of Ambit Asset Management Business. He's been also a part of Ambit's executive committee. He's been with the firm for more than 11 years with a total industry experience of 18 years. Sushant is a rank holder, chartered accountant, and also a PGDBA from Indian School of Business. Welcome, Sushant. And about Aishwarya, he's been in the industry for over 12 years now. Has been with Ambit for about I think more than 2-3 years now, and he has got rich experience of fund management under good and clean framework. He's a qualified chartered accountant and an MBA finance. He's also a CFA holder from CFA Institute. And Manish has got over 15 years of experience. He was with Nomura for over 10 years and lead analyst, and has got a lot of among the best performing analysts I know for sure, because one of my friends also was his colleague. So he's one of the best performing analysts in the research team for a long enough period. He's also an MBA in finance. So I welcome all three of you and thank you again for taking your time out. So quickly to start with, a question which is on everybody's mind today. Where exactly do you see market opportunities today?
Well, markets have been in sort of a role for last few months, right? And after the knee-jerk reaction which we saw in March, right, I think market has recovered quite well, and we had expected this return in around the same fashion, but not in the same magnitude. Right? We expected a V-shaped recovery in markets at least, because the reaction probably was too high as compared to what the effect of the pandemic could have been on the economy from a next 2 or 3 year perspective, rather than just a short term perspective of 2 or 3 months or few months. Right? So our expectation was that by Diwali or by end of year, market should reach back to the levels before COVID, because by that time normalcy would have come and the panic which got created in the marketplace would have been out of people's mind. As we speak today, I think the fear is still out in everybody's mind, and as you can see, while you are in office, most of us are still at home. Right. So 4 out of 5 are still at home. That means the fear is still in everybody's mind. And that's true for, I would say, people in metros and large cities. So probably top 10 cities in India. Beyond that, I think things have a bit normalized. People are not that scared. I think government intervention is still very high. People are not allowed to be in large social gatherings, right? So people are visiting their business place, people are visiting their relative places, but large scale events are just out of motion for probably next 6 months. So we expect that not before 2021 when everybody will start coming together. Right? So that's the state of economy. I think normalcy has come back to 60, 70, 80% depending on which geography you are in this country. Rural as such is booming. The rains have been really good. Last 2 years, rains have been a bit of, I would say, seesaw in terms of sometimes high, sometimes low. But last year, the rains were really, really good, and which led to a high level of underground water levels, which has been sort of unprecedented probably in the last 10, 20 years, right, throughout the country. While it led to lots of crop damage because of high rainfalls, I think, but from next season onward, it helps a lot, and which is what is I think happening this year. Fortunately, so far the rains have been, I think, above the normal long-term average. So rains have been kind this year also. So rural, we expect that there, and it also, I think, the tractor sales depict it quite well. That rural is just thriving, and probably rural will be the savior for FY21, if I may say. So from that perspective, while urban India will probably take some more time, markets at this point of time looks balanced in terms of, I would say, earnings expectation. As we are already in August, September, you start now looking at FY22 once you reach a sort of halfway of the current fiscal year. So from that perspective, FY22 level, I think 11,000, 11,500 Nifty levels seems to be quite balanced, not a probably a extreme rich case. Aishwarya, Manish, any views?
No, so I think you summarized it well. And what we believe is that, possibly the traction in the economic recovery, though will not be very V-shaped or a sharp one, but it will be more gradual. It will be basically been fostered by rural side of the economy, from the agriculture side of the economy. The reason Mr. Sushant mentioned it a bit earlier. The recoveries will be uneven. That is for sure. Because even the data which we are seeing on high frequency indicators, we're not seeing a very clear trend. But possibly by end of this calendar year, we will start to see that normalcy will be there, and things which will take it over there will possibly something on government capex has to happen to revive the whole sentiment. Because see, if you look on the private capex side and looking at with the impact on the corporates as well as the utilization of the capacity, are both not showing any right indicators that the private capex will recover anytime soon. So the only two low-hanging fruit that we have, which can really boost our economic front, is basically what rural-based economic recovery, agriculture-based economic recovery, possibly something on the government capex side, and possibly the resilience of the Indian, being a more inward economy, more domestic, and possibly if something start kicking on the credit side, which we are not yet seeing. If you really look at the credit growth, is just less than around 6%, the latest data which we are looking at. Though the deposit growth are at 10 million percent. So we have to see this credit move up to low double digits, 10, 12%, which should probably happen by end of this calendar year. Rate cut is another thing which should also be there if the inflation's mellowed down in the coming month. But I think all of this factor will start kicking in. But the bigger comfort that I have is possibly, I believe, though we are seeing the highest number of cases today, right? But the fear is we have left it back. The reason being, if you just look at the test positivity rate, we have gone below 9%. We are close to 8.7, 8.8%. We are now testing more than 9 lakh 10 lakh cases a day, right? Our recovery rate is just shy away from 75%. Our mortality rate has gone below 1.9. So all these indicators will boost very well for that possibly the fear which was there for the last 1.5 months, that this corona thing is going to Bharat instead of India now.
Right.
So instead of it is going there, we believe it will stabilize in the coming month or two, because this TPR rate is very, very important, and that is stabilizing. So I think that will give a boost to the whole thing to come back. And what Sushant mentioned earlier, that we are working from 60 to 85% of the capacity utilization across our system on economic front also, possibly can go to 90%, 95% in pockets in the coming times. Anything, Manish, you want to add which I might have missed out?
I think you summarized it pretty well, except that just one more thing that I may add. There's one more thing which I am very positive about, which is basically discretionary consumption in the urban metros, and this is something that we've seen been playing out for the last couple of months. If you look at particularly large appliances, if you look at two-wheeler growth, and if you see the trajectory of growth that is playing out between May, June, and July, I think we are seeing a very distinct pickup which is happening across the board. This possibly could be, probably 6 months to 9 month, 1 year phenomena where there is a certain bit of a habit change in terms of the way people consume things because of the inconveniences that you have undergone, whatever it is, probably more psychological than any kind of a economic rationale that you have. But that also, in my mind, is a very positive indicator. If you look at the gross merchandise value across e-commerce companies, if you look at the way month-on-month sales data for two-wheelers and four-wheelers have been playing out, if you look at the appliances category, right, they are all in the month of July now been growing in double digits. I think that again, for me, is a very positive indicator. So that I take a lot of solace in.
Good. So Manish, I have one question. So congratulations first on topping the 3-year return across all PMS in India and also being one of the most consistent large cap PMS. So I have a question around the macros particularly. I mean, one is I understand US markets are at all-time high already, and we are not too far either. As China is back to normal, well, almost, and EU is also recovering. But I also see that RBI's stance is very accommodative. The market is pricing in a lot of dovishness despite rising inflation. Do you see interest rates being at these levels for long enough period?
I think there are two things to it, and this is something that Aishwarya alluded to earlier itself. Is that right now we have seen a certain bit of a spike which has started happening in food inflation, right? Which is essentially leading to the CPI numbers coming above the threshold level that RBI has set for themselves, and that is essentially the reason why we've kind of taken a pause in terms of rate cuts this year. And my view is that there are two scenarios which play out. If the inflation overall in the country kind of eases out a little bit in the coming months, then you potentially can see one more rate cut happening this year. Otherwise, we go into a pause mode for this calendar year, but you come back with a certain bit of more rate cuts next calendar year. So that's essentially my view on interest rate. Ash, you want to add something?
Yeah, so see, the risk is anyway there, and I think we are in the fourth month of consistently high CPI inflation, and not only CPI, the core inflation which is hurting and with a concern. But we believe somewhere this is more to do with supply side issues rather than truly demand side. Because demand is optically low. I should understand what the way I'm saying, right? But there's definitely supply side things which is impacting the prices. And if you look at going deeper, you believe that the vegetable prices and all those prices have gone up very almost 15-20% higher, right? And this is primarily in spite of very high reservoir levels of water, very high harvesting which has happened across the whether it is grains or vegetables or whatnot. So I believe these are more of a supply side issues which gradually will come into places in the coming months. And possibly, though I'm not saying whether the RBI number of 4% will be achieved, but definitely the trend will start moderate. Now the question is whether we will see another rate cut in October MPC meeting is something I would say there's a 50-50% chance here. But if you start see another 100 bps or 150 bps of moderation in the next week, the chances can go to as high as 75 to 80%. Now, coming on the interest rate, the first time we are seeing that the transmission has started to happen, right? For all the cuts that has happened so far. And I think almost 35-40% have been already been transmitted by the PSU bank, right? And on top of it, we have seen that, the whole system lending liquidity is coming in place according in line with the transmission, which is gradually picking up. So I believe any further rate cut from here will be taken very positively, and we still have a lot of cushion with our existing rate cuts, and we have enough liquidity. So all this thing will. So from the monetary perspective, I'm very positive, right? And possibly, if not in calendar year 20, we will definitely see in the start of the calendar 21 there will definitely rate cuts which will happen.
I have a question again for you, Aishwarya. First of all, again, congratulations for winning the Best Midcap Fund Award over 3-year period by PMS AIF World. Congratulations on that. I was just reading through Mint today, and I read an interesting data which says that, while I understand Ambit is all about quality, in the last 3, 4, 5 months, companies which have got not so great financial ratios have done better than better financial ratio companies. While when the fall happened, the better financial companies did not have so much of a drawdown. But when the rise happened, it was bad financial companies that did well. So can I have some views of yours on this particular?
This is a very good question, I would say. And if you try to see the answer in just a frame of 3 to 6 months, possibly we will not get the right lead. I believe the answer lies in the history of the broader market of the last 3 to 5 years. Right. So when you're talking about all those companies which have not have the best of those financial parameters, right, or who we believe are not good and clean, or those companies who are weaker, right, actually they have been crashed in the last 3-4 years of a movement. So if you really look at the broader market per se, right? So which for indicator like BSE 500, which is basically your the 500 companies, and this is small cap, which is more than 200 plus companies, out of which I think 80-85% of the companies belong to the companies which you are highlighting about. They've been massively underperforming in the last 2.5 years, right? So, and the reason has been that the economy was slowing down in the last 2.5 3 years. We had seen a lot of reforms, whether it was GST, e-way bill, whether it was RERA related, whether it was IBC related, whether it was demonetization that happened, all sort of things. And the most important, I believe, is the higher scrutiny of the IT on that thing. So which all derailed the whole process of growth for all these companies. And I can tell you, they were all massively crashed in the last 2.5 years. So they said a Nifty small cap 100, in spite of all this, was still down roughly 25% before March.
Right.
So if you connect the dots now, and the rally after the 2.5 years from January 2018, they saw a very tough time for the 2 year. The rally started happening, building up in December, January 2019-20, right? And then we hit in COVID. So the rally which we are seeing in all these names is basically they're trying to reverse back, on the very much lower valuations and the price impact they had already witnessed. And when things started to improve, then when people realized that this Corona thing is possibly not that fatal, it's not going to end the whole world. Possibly the smart money started allocating over there because there had a lot of valuation friction. So I think that explains why these companies are performing better compared to the one which are stronger.
Okay. Thanks for that. Girish, your question was Sushant?
Yeah. Sushant, I was reading August newsletter where the introductory remarks were about old wine, new bottle, and you quoted Mark Twain that history doesn't repeat itself but rhymes. You also wrote about how markets go through similar cycles and patterns again. I want to ask you that what are the pitfalls that investors should avoid in these kind of markets, especially since the overwhelming concern is that markets being disconnected from reality. You spoke about polarization, chasing stocks as yields, a lot of interesting things that you mentioned in the newsletter. I thought I'll have some discussion around that as well.
Sure. So I think the biggest pitfall, if I would say to avoid, is to get into the frenzy of market and people. I think everybody you speak today is saying that I've made 50% in this and 100% in this in 2 months, 3 months, 4 months, right? All these reminds me of 2017, mid 2017 and 2017, right? Normally this happens at the end of the bull cycle, these situations, right?
Yes.
That
Yes.
you pick up anything and it grows by 20% the next week, right? Or 50% in a month return. So normally that cycle, like I've seen always at the end of bull cycle. But this time suddenly it is sort of, I don't know whether it's the beginning of our next bull cycle or probably the end of the sort of frenzy which started just 2 months back, right? Normally these things don't last enough. But if you look at what Aishwarya said just now, that you have to look at a 3-year history and then see that rupees 100 has become 20 in last 2.5-3 years, and that 20 suddenly becomes 30 or 35. Right. So people who were lucky enough to enter at 20 rupees and make 30-35 probably are lucky, right? But normalcy is still away. And while 100 probably also was an exaggeration for many such companies. Some were commodity linked. There were many examples where people made 3x, 5x, 10x returns in a matter of 1 or 2 years. But those were more commodity driven rallies, which got out. But there were many more, which also, when the frenzy is there, everything sort of picks up, right? And you try and look at a story in an angle in every stock, right? So that's the pitfall one should avoid, whether you are a retail investor or a sophisticated institutional investor. I think these pitfalls is something which you have to shy away from. Similar to the pitfalls of March, where I think there was a big sale, but nobody bothered to buy stuff that time. Right? You have to keep your cool and calm and take a rational decision. Have a 2 or 3 year view of at least things. When we see 10-year charts, we always see that there is a perfect sort of linearity. That things we looked at each and every company, Right now, on a 10-year chart basis, it looks extremely fine that market cap is following the earnings and nothing else. The trend is always same. The multiples might increase definitely from 20 to 40 also, but that is also on account of the earnings growth as well. Right?
I have a question for Manish. Manish, how much has this economic slowdown impacted your universe of stocks to pick from?
No, so there has been a very diverse kind of an impact. If you look at it from a time frame perspective, obviously in the near term there are significant challenges that have kind of emerged out for everybody, which is on the logistics front, which is on the consumer taste and preference front, which is on the fear psychosis front, right? So there are significant challenges that have emerged out now, and that was one of the reasons why what we did the first thing. When the whole coronavirus crisis kind of started breaking out, was to look at the survival instinct in our portfolio, right? So we did this study across all the three portfolios that we have, which is Coffee Can, Good and Clean, and Emerging Giants, to see how many of our portfolio companies, and there were about 47 of them at that point of time, are going to be able to survive if the lockdown was to last for an extended period of time. Suffice to say that 45 out of 47 companies actually came out in the green zone. That means they had the ability to survive, with an extended period of about 6 months without any revenues whatsoever, covering their entire fixed cost and a part of the variable cost as well, right? So these companies that you see not only have a great balance sheet, they do not just have a strong industry leadership, but they also have a very strong survival instinct within. And our belief is that if you then take a slightly longer term time frame horizon from an investment perspective, take a 2-year or a 3-year view, then each one of these industry leaders or segment leaders are not just going to survive, but they are going to thrive. The big are going to become bigger, right? And they are going to become more profitable. The reason they become bigger essentially is because there is going to be significant churn in the industries, in the market. The MSMEs are going to come under pressure. There is going to be a market share movement which is going to happen, from smaller players to larger players. And there is going to be a certain permanent change which is going to happen in the next couple of years in terms of the way logistics in India is playing out. You'll see a lot more robotics into it. You'll see a lot of, artificial intelligence coming into play, a lot of automation coming, into play. Industry stalwarts and leaders like HUL have already sown the seeds and shown us the path towards that in the last couple of years or so. And that is going to mean that your overall logistics costs are going to come crashing down, and that would mean that your profitability is also going to improve. Now, with that perspective in mind, what we have done is try and position our portfolio in a way that not just plays out this current theme, but also kind of benefits organically from the overall crisis and the way it is emerging, right? So when you look at modern trade, when you look at industries like F&B, when you look at the entire BFSI space, when you look at the entire staple space in India, insurance is another industry, and these are the industries that are going to see a very accelerated growth over the course of next 2 to 3 years, and they kind of benefit out of it. So what my sense over here is that obviously there is a lot of confusion in the minds of investors, right? Which Aishwarya kind of alluded to, which is that there is a certain bit of a dichotomy as the way the stock markets in the last couple of months have performed. Valuation optically seem a little bit of rich, and people are in general confused in terms of how to go forward, right? The way forward is going to be. And in that sense, I think the best thing is to invest in quality from a 2 to 3 year perspective in Sunrise or Sunlight Industries, in good quality companies where corporate governance practices are very strong. And you'll obviously see the earnings growth coming through over the next years, which is going to be far more higher than what we've seen in the last 3 years. And the returns automatically being much higher in the next years as compared to what we've seen in the past.
So essentially, survive and thrive is what is.
Absolutely, summed it very nicely.
So nice.
Yeah. One quick question on PVR. Any of you can this thing. You kind of. I read the letter about PVR a month back. In July, sometime you had sent it, and from there the stock is up 30%. They've also done rights issue and all. So, like what Sushant just mentioned, that returns maybe are upfronted or tail-ended. So I don't know what, but just wanted to understand the story of PVR from you. What's playing at 30% in a month it's returned with negligible revenues. So what are we kind of looking at PVR? Just a quick bite on that as well.
And also when they are opening up, that would be good to know. Anybody, sorry.
Yeah, anybody can. It's for anyone of you.
Ash, do you want to take it?
I think the second question is an important one. Let Sushant take on this.
Sure. So I think, see, PVR, any stock if you take, whether it's PVR or anything, right? And market is simply amazing, right? We all knew that a stock's value is a lifetime value and not next 3 months or next 6 months or next 9 months, right? But people get zapped by saying what's happening in short term. And, that's what has led to now that just and everybody used to ask us in our monthly calls that why are you still holding PVR?
Yeah.
Right? And our belief was that one day it has to open, right? And if anybody will survive in this whole industry, it will be PVR. It's the last one to survive, right? And if everything crashes, then probably if PVR is crashing, then probably the whole economy is going out, which means we are in a very very bad phase. So it doesn't matter whether PVR survives or not, right? Then we are taking a call on Indian equities, right? And if we are positive on Indian equities, then PVR has to come back someday. And whenever it comes back, it will come back much more stronger in the marketplace because from the supply side of exhibition industry, I think there will be only two large players which will be left, which is PVR and probably the next line in competition. And the other two large players, probably one of them was already we heard was looking out to consolidate into the top two players because of India not being a strategic probably area of interest for them anymore. And the second one, the fourth one, the third or fourth one was also into a large debt trap already. And if people were very high on debt in this time period, I think it was very difficult to survive. And PVR already had cash on their balance sheets, and I think given the PE backing which they had historically, it was easy for us to assume that they'll be able to raise capital if there was a need. And we were actually quite shocked and surprised by the way they cut down their costs. When we did an analysis in March when COVID hit us and said that this, 6 months should be able to survive with such a high fixed cost, but they cut their cost by almost 60% in next 2 months on their fixed cost, right? And they are continuously doing further on that. And that actually one thing I have noticed across the corporates in this country, the good ones actually have used this opportunity to cut their cost, realign their business model, and I think the effect of that will be seen much more in FY22 and 23 when your revenues probably will be back on track, but the costs are now curtailed down to a large extent, and especially in media and entertainment, right? Another stock of our music broadcasting, right? So they already were going into sort of crisis when revenue growth was not coming for last 1 or 2 years because the economy as such has not been doing well. But they used that opportunity that we will not increase their cost. And when COVID gave them an opportunity, they actually made the threat into an opportunity where they may further reduce their cost, right? And they've now tweaked their business model that work from home is sort of a new norm for them. So the cost of studio, cost of people, aligned, everything has suddenly come down. And these levels will continue. So cost will only bump up by 10-20% going forward, but the revenues will come back. So the flow in, especially in these media and entertainment industry, the revenue, whatever you get, simply slows down as a pet sort of net of taxes, right? So that operating leverage is actually becoming much and more stronger and heavier for all these good guys, the leaders in this industry. Coming to the question of when PVR will open, I think government has now indicated that probably about early September is when they'll start opening. I think there are some guidelines which have come into play, and each state also will have their own set of new guidelines for each of them. People are saying 1/3 capacity and 50% capacity. I think any which way the capacity utilization would have been low in the initial phase. Right. Once people are comfortable, once you've been there once, then you will end up going again and again. And I think the beginning will be slow. So there will not be any large blockbuster movies which will play out. People will wait, I think, till Diwali time to come out with the pending blockbuster names, right? Which have not been since March. Right? There were some names which were supposed to come in April and May and June and July. They were release planned every week, right? So all these holiday period movies will come into play, I think, towards the Diwali time.
Right.
And that should lead, I think, once you have a great content in place, and then the fear psychosis sort of out over a period of time, I think that will again lead to massive collections for PVR. That's our thought process.
Thank you. Yeah.
So on Wednesday, I had released a video where I spoke about our our approach towards small cap. And I generally feel that many investors have this feeling of, oh, did I miss the bus by not getting into equities in March, April, and all that stuff. And I believe small cap is a great opportunity, but none other than can definitely talk about small caps. Why small caps now?
Yeah. So one of the very important thing which I alluded earlier also, I completely in concurrent with your views. I believe broader market is the place to be right now, and a lot of people who are having a feeling of FOMO that a lot has been missed out. That's not the case. I repeat, if you really look at the last 2.5 year return of small cap, and if I talk about Nifty small cap, and in spite of all the rally which we have seen in July, actually also in August, still small cap is down 38% from your January 2018 levels. To cover 38%, you have to go 70 with 80%, right? So that kind of even if you cover that number, you're coming back to the base. And we should not forget that the small cap has been underperforming. Even mid cap and small cap has been underperforming for the last 5 years. And I mentioned about all the reasons which were there, right?
Right.
So possibly the biggest money is always made. Remember that when things go from worse to bad to moderate to good. Money is not made when you go from moderate to good. So this is actually the time to invest and increase the allocations to the broader name. But this is also very important that because we still say that aftermath of this corona impact is still not clearly seen, right? So it's very important when you're investing into small caps or mid caps, you have to be very sure about the positioning of the business, about their ability to survive and thrive, which you mentioned earlier. That is of paramount importance. So obviously there is a big opportunity in the small cap and the mid cap space, but I believe it is one has to be with the quality names, and I can tell you their valuations, in spite of all the movement which has happened in the last couple of months, are still lower than the January or February of 2020 levels, as well as also much lower. Not we can't even compare the valuations to December 2017.
Yeah.
So the valuation, the opportunity still lies, is what I want to say.
So do you also see lopsided returns coming in? I know we can't predict it, but do you see, because many people have burn their hands with small caps and mid caps for a long enough period, but I believe lopsided returns are around the corner. Do you also believe in the same, or what's your view on that? Sure.
So see, always small cap returns will come in not in a structured manner, but more in a punchy sort of a punchy sort of phases. So see, I can tell you that the return, the catch up can give some side of lopsided return for some point of time, right. but it will also give us a structural return from 2 to 3 years perspective. I'm not saying that small cap and mid cap you should invest with 3 to 6 month time frame.
Right.
What actually I meant is if you look at from the various high other indicators, I don't want to go into too much detail, but the rally will probably stay for 2 to 3 years. And if this interest rate stays at this level, this will make a really big case for the mid caps and small caps going ahead. So possibly there will be some sort of lumpy return initially, but then 15-20% CAGR is not something which can be ruled out.
Sure. Girish?
Yeah. One question that have fundamentals become kind of insignificant? Is liquidity the only thing that we need to worry about and track to see where markets are going or will go tomorrow? A very broad question, but some thoughts from you, any of you.
Equities will always be liquidity driven, right? Within the equities, which stocks probably are fundamentally driven, but equities overall will always be liquid because what is equities? It's a stock market where people are buying and selling. So it's always demand and supply. So the more the demand, which is liquidity, the more the prices will run. The lesser the demand and probably more the supply. When people are panicking, that's when markets go down. So on a broad level, it will always be liquidity which defines the equity trend. Within the overall market, then it's always fundamentals.
So let me correct. I meant easy liquidity. That's
No. So liquidity is always that's what liquidity is, right? Easy or hard, right? So when right now because of quantitative easing, right, what we saw in FY19 to FY9 to FY12, when Fed was always printing more and more, like we suddenly saw a 3x, 4x in a matter of few months. What they did last time, in a matter of years, right? So that liquidity, once money gets printed, it has to go somewhere.
Right.
Right. And a small portion always comes to equity, and a very small portion always comes to emerging countries like India. Right? And then in India, if you look at it, the quality companies are very few. Right? The problem in a country like India is that people don't want to get themselves listed. Right? And it's increasingly becoming difficult to get yourself listed. So if a sound promoter who is running a very good business, why would he want to get listed? If you look at last 10-year history or 20-year history, people who have got listed, either it's because of government divestment program or corporates unlocking their value, right? They are already listed and they are sort of their subsidiaries getting listed, whether in case of insurance companies or some NBFCs in some cases, right? Or the third category is where people have got private equity investors, which means that they needed capital, but they couldn't come to equity markets on their own directly through an IPO. So they chose a private equity route, and then to give them an exit, they have to get themselves listed. I would say there will be less than 5% companies who have got themselves listed just because they want to get listed and get money from markets, right? Financial services is the only play where you can say there because they need capital always from a regulatory perspective. So they will always come to the market, and listed market works best for them, right? But bearing financials, I would say not there. You figure out some good brands in consumer space. So if you have a very good business model already in place, whereby you are limiting your growth rates in line with what you are earning. So you are running a capex cycle where you invest and then generate sales out of it, generate profits, convert that into cash, and then again reinvest into business. If you're following the good business cycle of 5-6 years of such thing, you actually never need to go to markets.
Right.
Some very good companies got listed in 80s and 90s and 2000s more because of regulatory reasons than because of capital requirements. Right. If you ask a company like Nirma, one of the best brands in the washing powder, right? Superb cash flows, and it's not that they are not taking this; they are getting into cement in a big way, right? And there are some other businesses, look like groups like Dharmapal Satyapal, right? Absolute rich guys, probably $1 billion plus turnovers, right? But they don't need to get themselves listed because they have so much cash flow that they can expand their business in the same category as well as expand in the new categories which they want. See, in India, any individual. I think I was giving this example that if you are a promoter of a company of which earns 100 crores of profit, right? You are right now sitting with, and you are an unlisted company. You are probably sitting with a large listed promoter who has a 20,000 crore, 30,000 crore market cap, right? Because you end up having the same lifestyle, right? So your social circle is same. If you get listed, you get to know that my market cap is only 3,000, 4,000 crore, while the other guy is 20,000. Suddenly there is a difference,
right,
on the pedestal, right? So this social, I think, social taboo also in our mind that market cap equates things also plays a big role. And you guys manage well for your clients. Right? You know so many promoters; they are all unlisted players. Right? When you ask why is the reason, right? Because in India, one, I think the tendency to once you have a business, it is for centuries, right? It's in your own destiny, right? Your whole family will have to continue, right? The culture globally is that you build a business, you cash it out, you get it listed, right? There are very few businesses which continue to be in the family. Otherwise, professionals run the business. You cash it out at some point of time, and gradually institutional investors take over the business. Yes, sir. And all the boards are, I think, who's the who of the world, right? In India, if you look at the board of directors, you probably have some good companies having some good, but if you look at unlisted companies, where are the board of directors? There's nothing, right? It's just family. So if you don't have good supply of paper, right, and then whenever the market, I think, gives you opportunity, then when more and more money comes to equities, and that is I think, a function of not just the liquidity, it's also a question of the choices which people have to invest. Right now, if you look at it, what choice do people have? Do people invest in real estate? No. Do people invest in gold? I think they probably miss the bus, right? And any which is gold cannot be a very large allocation, right? Do people go into debt? They have just burnt their fingers, and probably hands, right? So where do people go, right? Sitting at home, not able to spend, the savings are only increasing. So you play in equities, right? So that's why more and more money comes to market as and when new opportunities arise, as and when I think real estate opens up better way, as well as yields come back into playing commercial. I think money will move over to that side of the asset class, and less money will come to equity. So that's, I think, the whole prognosis in my mind of equity markets, why India is always expensive.
Got it. So I think,
Insightful.
yeah, it was very insightful. All three of you, Sushant, Manish, and Aishwarya, all three of you. A big thank you for taking your time out, and it was a very wonderful discussion. I'm sure our viewers will definitely like this. Girish?
Thank you so much for taking time on a Friday. Very insightful discussion, and really thank you.
Great, thanks a lot.
Thank
you. Our pleasure. Thanks.